At some point, the stock market will crash again. It is not a matter of if, but when. For all we know, the market could crash tomorrow or next week, and I might look like a genius who predicted it. And lately, it seems like the warnings of a crash are getting louder and louder. Major institutions, whether it is JP Morgan Asset Management, Vanguard Group, and even global policymakers have been sounding alarms about stretched valuations, extreme market concentration, and even a potential AI-driven bubble. And yet, against all odds, the market could just as easily keep climbing, not just for months, but even for years, before the next downturn finally arrives. Because the truth is, expensive markets can stay expensive for a very long time. Take the late 1990s for example. In 1996, the then Fed chairman Alan Greenspan famously warned of irrational exuberance, but instead of cooling off, the market surged nearly 100% over the next 4 years, before the dot-com bubble finally burst in 2000. Still, one warning remains true. When markets are as richly valued as they are today, future returns tend to be lower. Whether you look at the next 1 year or the next 5, high starting valuations have historically translated into smaller overall gains. So on one hand, we might be living through a bubble inflated by AI hype and easy money. On the other hand, this rally could still have plenty of momentum left before reality finally sets in. That's why in today's video, I want to share how to invest right now and what you can do to prepare for a market crash, whether it happens next week, next year, or even further down the road. Now, if you ask me, personally, I believe that the stock market will continue to go higher, at least for now. And there are two main reasons for that. First, despite all the talks of bubbles and overvaluations, corporate profits remain near record highs. At the same time, Wall Street analysts are becoming more optimistic about the strength of earnings. According to FactSet data, 7 out of 11 S&P 500 sectors have seen more upward earning revisions than cuts, and around 82% of companies that have reported so far have beaten analyst estimates. This shows that businesses are still managing to protect their profit margins, even in a high-cost environment and despite renewed tariff uncertainty. And then there's the Federal Reserve. The Fed is now widely expected to continue cutting interest rates into next year as inflation cools and growth stabilizes. At the same time, Fed Chairman Jerome Powell has also recently suggested that the Fed's quantitative tightening program could soon come to an end. So what happened was that since 2022, the Fed has been steadily reducing its balance sheet through QT. Since then, they have shrunk the balance sheet down by about $2.4 trillion. The reason they wanted to do that is because they wanted to cool inflation down and bring credit growth back into control after years of aggressive money printing during the pandemic. And now, with the QT program ending soon, liquidity will be returning to the system. What this means is that the Fed will stop pulling money out of the economy and may soon start putting it back in. Historically, whenever the Fed has paused or reversed tightening, markets have tended to rally as liquidity conditions ease and risk appetite returns. And here's a potential proof of it. So last Friday, the VIX, which is also known as the Fear Index, spiked to above 28, while the S&P 500 was trading within just 3% of an all-time high. Historically, whenever volatility jumps while the market is still at near record levels, the next few weeks tend to be choppy, with heightened swings both up and down. But here's the interesting part. If you look out over longer periods, from 2 months to a year later, the S&P 500 has ended up higher every single time, with an average 1-year gain of around 20%. Then, just a few days later on Tuesday, the VIX collapsed by about 36%, while stocks surged. This kind of dramatic volatility crash is rare, and in the past, it's usually signaled the start of a short-term shakeout, followed by a stronger rally down the road. Again, data shows that while the markets may stay volatile in the weeks to follow, 6 to 12 months later, it has ended in the green 100% of the time. Quick pause. Test your trading skills and stand to win real prizes in the second Global Paper Trading Championship, proudly brought to you by Mumu and Nasdaq. It is a fun and risk-free way to learn how to trade US stocks with no real money required. You will start with $1 million in virtual funds, and as long as you stay in the positive territory each week for 5 weeks, you will win a share of $200,000 in total rewards together with other successful traders. The top 3 global winners will each take home up to $10,000 and even get featured on the Nasdaq screen in New York's Times Square. And the best part, this is completely free to join. Just use my link to register for the competition, and you will also unlock an additional 1 month access to Nasdaq Total View market data and 1 month of Opera options quotes. If you are new to Moomoo, you can also earn up to $1,315 worth of welcome rewards, including $60 of Nvidia shares. And if you join the paper trade competition, you will also be able to receive an additional $5 cash coupon. This is on top of zero commission for US, Hong Kong and Singapore stock trading, and zero commission US options trades every month for up to 100 contracts. Simply follow the steps here and key in my promo code Kelvin88 to earn your exclusive reward. For full details of the promotions, do check out the official page linked in the description below. Now, of course, not everything is rosy, and there are still market risks ahead. For one, inflation has remained stubbornly sticky, and with the Federal Reserve cutting interest rates and winding down its quantitative tightening program, there's a real risk that inflation could re-accelerate again. However, the reason the Fed is still being forced to ease policy isn't because everything is fine, but rather it's because cracks are starting to form in the job market. So right now, the number of job openings and job creation has fallen to their lowest levels in over 3 years, while layoffs are going up across some industries like tech, finance, and manufacturing. That's why the Fed is in a difficult position. If it cuts rates too late, it risks tipping the economy into a recession. But if it cuts too early, it could reignite inflation just as it begins to cool. Which brings us to the real question: how should we invest now? For most investors, the simplest and most effective approach is still dollar cost averaging. The idea is simple: you invest consistently. Market up, you buy. Market down, you cry a bit, then you buy even more. Over time, this smooths out your entry price, takes emotion out of the equation, while ensuring that you are always participating in the market instead of sitting on the sidelines waiting for that perfect dip that may or may not come. However, when it comes to what to invest in, here's where my approach differs slightly from the crowd. While most people and even Warren Buffett recommend simply buying the S&P 500, I personally think that even the S&P 500 isn't as diversified as many people assume. If we look at the holdings, the S&P 500 is heavily concentrated in the US tech giants, with the top 10 companies making up more than a third of the index. It is also entirely dominated in US dollars, meaning you aren't just betting on American businesses, but you're also betting on the strength of the dollar. And that is a risk that most investors don't think about. Then, if you zoom out to the global picture, the S&P 500 represents only around half of the world's total stock market capitalization. That means the other half of global opportunities lies outside of the US, whether it's in Europe, Asia, and many other regions that are home to some of the most innovative and fast-growing companies on the planet. Take ASML in the Netherlands for example. It builds the world's most advanced semiconductor machines and powers the entire global chip industry. Or Novo Nordisk in Denmark, whose weight loss and diabetes drugs have transformed modern healthcare. Or how about Mercado Libre from Latin America, which dominates e-commerce and digital payments. Then there's TSMC in Taiwan, the world's largest chip foundry, and Samsung Electronics in South Korea, a leader in memory and display technology. Without holding international equities, investors may risk overlooking entire industries and innovation leaders that lie outside American markets. So it is sort of like ordering from only half of the menu at world-class restaurants. Sure, you might still get a great meal, but you are missing out on many of the other flavors, textures, and even ideas that could completely redefine your experience. And if anything, history shows that market leadership never stays in one place forever, whether it's the Great Britain in the 1900s, Japan in the 1980s, or the US in the 2010s. Now, however, if you prefer a more active approach to investing, this is where valuation really matters. Because when a market crash comes, even great companies can see their share price fall hard. In 2022, for example, when the stock market was crashing, tech giants like Meta, Amazon, and Netflix all saw their stocks plunge by 50% or more. And if you didn't know what you were buying, you would have panic sold away many of these great businesses at a huge loss, when instead, you could be buying them at a great discount. That's why focusing on the fundamentals of a company is so important. Take Amazon during the dot-com bubble for example. Between late 1999 and 2001, Amazon's share price plunged by more than 90%. Later on, here's what Jeff Bezos said.
That whole period is very interesting because the stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics: number of customers, profit per unit, everything you can imagine, defects, etc. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way.
So even if you have bought Amazon at its peak, as long as you understood the company's fundamentals and stay invested, you have eventually seen those paper losses turn into extraordinary long-term gains. The stock that once fell 90% went on to rise more than 300 times over the next 2 decades. However, on the other hand, not every company is a great business. After the 2022 crash, many speculative names from Peloton to Lucid and Rivian lost most of their values and have struggled ever since. Now, here's a very interesting concept: free cash flow yield. Credits to Joseph Carlson for explaining this in one of his videos, which I will link down below. Basically, the idea is that free cash flow yield tells you how much real cash a company generates relative to its market price. It's calculated by taking a company's free cash flow, the cash left after paying for operations and capital expenditures, and dividing it by its total market cap. So, for example, if a company earns $10 billion in free cash flow and has a $200 billion market cap, its free cash flow yield is 5%. That means for every dollar you invest, the company is generating 5 cents of real cash per year. The higher the number, the more value you are getting for your money. So you can think of free cash flow yield as the stock market's version of a bond yield. When you buy a US Treasury bond, the yield you get, say 4.5%, is your return for lending money to the government. Similarly, when you buy a stock, its free cash flow yield represents the cash yield you are earning for owning a piece of that business. So take for example, right now, Apple has a free cash flow yield of around 2.5%. That is lower than the 20-year Treasury yield of 4.5%. On the surface, it would seem as though bonds offer a better deal, right? Because why would you even own a stock that's giving 2.5% yield when you can own a bond that can give a much higher yield that's also risk-free? But here's the difference. Apple's cash flow can grow, whereas Treasury yields can't. When you buy a bond, your yield is locked in during the period. But when you buy a company like Apple, you are buying into a stream of cash that expands as the business grows. In Apple's case, their free cash flow per share growth rate was around 13.7%. But let's just round it up to 15% for simplicity. With a 15% growth rate, Apple's 2.5% free cash flow yield would grow to 5% in just 5 years. That's already higher than the Treasury yield. Then, after another 5 years, it will rise to 10%, and by year 15, it reaches 20%, all while the same Treasury bond would still be paying 4.5%. As an investor, your goal is to buy stocks at below valuation, so that your future cash flow yield can rise a lot quicker over time. Basically, the lower price you pay, the faster your long-term yield grows. But of course, that kind of opportunity doesn't come often, but it does happen from time to time. For Meta, that happened in 2022. During the whole Metaverse saga, investors panicked and sold the stock, causing Meta's market cap to fall to about $350 billion. The following year, it generated roughly $44 billion in free cash flow. So if you do the math, there's a free cash flow yield of about 12.5%, meaning investors were earning a double-digit yield on one of the most profitable companies in the world, simply because sentiment turned negative. So if you bought Meta here, right off the bat, you will be getting a much higher yield as compared to the Treasury yield. But it doesn't just stop there. Meta's free cash flow growth rate was around 23% over the past 10 years. By the 5th year, Meta would have grown their free cash flow yield to 35%. That is a very high yield, and the yield continues growing. Naturally, once the market recovered, investors re-rated the stock back to a 2.7% yield, closer to its long-term average. When that happened, Meta's share price more than 6 times from its lows. However, on the other hand, if you had bought Meta today at a 2.7% yield, it would take you much longer to match the return of a Treasury bond. In short, you do not need to predict when the next market crash will happen. It could be next month, next year, or even 5 years from now. What matters isn't when it comes, but rather what you do before it does. because history shows that every crash eventually ends. And as legendary investor JP Morgan once said, in the bear market, stocks return to their rightful owners. So don't try to outrun the next downturn. Prepare for it. Keep a watch list of great companies. Know the prices you would love to own them at, because market crash don't destroy wealth. They transfer it from the impatient to the prepared. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.